Hey, another month. I love this. We're back with Over the Money Fence.
Who would think that we were back with Over the Money Fence? Because originally I said to you, I don't know about finance, Nick, on the potty. No one will really listen. Well, it's actually gone a full 360. I stand so corrected. We cannot believe how many people come up to us and go, I'm thinking, oh, great, they're going to say, we listen to Nick and don't know. They say, oh, we love listening to Roger. I'm going, excuse me, Roger?
And if they didn't...
What about us, you know? But it's obviously, it's connected with so many people whereby, beyond my wildest dreams. But ultimately, I guess what it is, it's something that hasn't been talked about enough.
I agree.
And we've brought it to the fore, and I'm so bloody grateful that this has come about.
I know. I'm so glad that we've got our monthly podcast, you know, and we honestly, if it wasn't for Roger Montgomery, you and I, we would never be doing it, you know. But I think it's
not in a million years.
No, but I just
love... we did look, let's be honest, we looked for months for the right person, though, because it couldn't be because as I've said to you in the past, anytime I'm watching someone talking finance, I glaze over or turn off.
Yeah. Oh, so do I.
Yes, yeah.
Do you?
Don't worry, and I'm in the industry.
Really? Roger Ruru, you're making me feel better. Did you used to do that?
Oh, totally. I had no interest. It was sort of like, you know, head in the sand there. But
seriously,
but,
give
you
me
know,
Coldplay.
if you hadn't
turn the channel.
And what I love about it too is we're now on YouTube, so you can actually watch us. So it's really good.
Now I've got to wear makeup.
Yeah. So if you didn't see us like on the morning show, you can watch us on YouTube. But it was like the feedback that we got. It was last month when we were on the morning show with Roger. Well, Roger was on the screen. We were talking finance with Larry and Kylie, and the feedback from that about this podcast.
Like, who would think we'd go on the morning show and talk about finance?
Yes.
Like in a million years, Nicola.
It was great.
Like, I mean, look, all I know is of late, I am now listening in the morning. I go, good morning, Google, to my little machine, and these two guys come up. I don't know, they talk about finance. I would like, get it off before. Now I listen, I go, oh, fascinating what's happening in the markets and the world, or whatever. I'm blown away. But, you know, now I feel more in control of where I'm heading with my finances. I used to have a lot of fear around it.
And I think that's it. We know you're not alone, and many of our listeners aren't alone. And if you're listening to this for the very first time, tune back to some of our other podcasts with Roger, because it's on. We've all had that fear about it, and it really is just that simple thing of talking about it.
Educating yourself.
And you can start again. Where do you start? Well, you start by asking a question, being sort of like really brave enough to ask any question. And that's like, you know, when we were with, you know, Larry and Kylie, and I thought it was funny when Larry said he talked about when Koshy, who was the finance guy that actually used to host the show, he was going, there were 3 words that Koshy never said, you know, finance is fun, because that's what we certainly make it fun here with Roger.
I find that hard to believe when you even say it.
Yeah, but we're going to today be talking about...
What else did Larry say? Does Roger ever get a word
I know. He said no.
Roger comes in, listens to us, and he leaves.
I know. And then he said, and the podcast goes for 9 hours. Well, I think we've done 9 hours of taping.
And they told me when I'm allowed to speak.
Look, honestly, if you're all listening now, you're going to learn a lot.
Tune in, you know, and you'll have a laugh, and you'll learn something new. I certainly am learning every day. And that's the other thing too, is you're never too late to learn. You can start at any age and any stage.
You said start again. I think it'd be good for people to replace start again with start now.
Oh, I love that.
Right, because
that's very Mel Robbins. I love that.
Well, starting again can sort of set you back and feel like it's another, you know, massive journey. But if you're just starting now, well, it's all new and it's all fresh.
Oh,
that is.
With me. I love that.
I tell you what, that is very Mel Robbins.
Very power of positivity too.
Yeah.
Like, come on, stop the tomorrows, stop the yesterdays.
And it's in the present.
Yeah,
and there's no other time, is there? No. You know, like
you're interjecting on our intro.
Yeah, and any time. No.
See, I told you there's a cattle prod, and it hasn't been.
Just be bossy sometimes.
Roger's like, okay.
But Roger, but today's one too. We're going to be talking about 3 buckets and simple ways to manage money, but we're also
talking. You're not.
But we're also going to have on this one too a landing page on our show notes. So if anyone here, can't listen or get a word in, or wants to actually later go back and sort of like, say what were they actually talking about there, condense it. We're going to have it on our show notes, a landing page. So
amazing you actually got all that in.
But just
the landing page is great.
Yeah, but look, the feedback, you've heard a lot from us already at the start. Keep it coming in. We've had so many people sort of saying we had our heads in the sand too. It's such a great thing you're bringing this subject, out there as well. People are tuning in that was never tuning in beforehand. Including us, which is great. So let us start today. So welcome back to Over the Money Fence.
Great name.
It is the podcast that sure helps you take control of your finances with clarity and confidence.
All right, so if you're staying tuned in the last episode, we're investing across many generations and life stages. But to be honest with you, some of you are starting over. Others weren't quite sure where your money should go next.
So today we're diving into something simple, practical, and honestly, what I feel is a real game changer. And it's called the 3-bucket strategy. And it's all about helping you manage your money, you know what I love? Without the stress.
Well, I still think there's stress, when you're dealing with money. I think it's like sort of calming the farm with it though.
Yeah, that's a good point.
What I mean? I still get a bit stressed, but I'm not as stressed as what I was.
We said it in a previous.
I haven't finished the intro, Roger.
Oh,
Am I giving you a hard time?
Yes.
I like it.
I
like it. I'm going to leave.
No wonder Kerry doesn't
come
listen.
back on another day.
That's Kerry from the ferry.
Right, Kerry from the ferry. So for all of you listening who possibly haven't heard Roger previously, we're listening today to Roger Montgomery, and Roger's the founder and chairman of Montgomery Investment Management. He's a very well-known media identity. We're so lucky to have him on the podcast. And he's been helping us and our listeners to be more confident. Honestly, it's that simple about money.
Yeah, so
you can say something now,
welcome
Roger.
back. He's
You
a
have
very
permission.
brave man coming on our podcast, that's for sure.
Not as brave as the first time when you had boas and
that's right.
tiaras
Tune into
on
that one. Our
and
100th
balloons.
episode was so good.
Was that the first time
That
you
was the
came
first
in?
time I came in.
Oh my God, I bet
It
you went,
was
what the
just
hell is
great.
going on?
I was really worried that was all for me.
It was. It was.
And you know the best thing is the other night at the event, we were asking all the guest speakers about, tell us, what's fun mean to you? What do
We
you do
started
in your life
off.
it's fun. And the first thing Roger said, and there's like 180 women out there, and he goes, well, not this. Oh, the whole house. You broke the whole house down. Everyone was going, oh my God, who's this guy? Everyone was
just telling
hysterical.
the truth.
I know.
So good though.
And it was
Because
great. We had Lisa
get it.
McGuigan, we had the winemaker, we
Fun.
had David the medium, we had,
too
tune
much
in all
fun.
our great guests on our regular Monday sort of podcast. But this is our special one. So, okay, Roger, let's, okay. So why this strategy matters. So
Very good.
let's set the scene. Why is strategy like this so important, especially, it's for everybody, but especially for women? Why strategy matters.
Well, if you don't have a formula or a framework, everything's confusing, and you don't learn anything from confusion. You learn more from stepping out and making mistakes than from being confused and not doing anything. And unless someone gives you a framework that says, look, nothing's perfect. There's no right answer. There's just different answers. But if someone gives you a framework and you understand it, well, that gives you the confidence to step out. Now, sometimes you are going to make mistakes. That's just life. But having a framework that gives you the confidence to step out means you're going to start learning and you're going to start moving forward. If you don't have a framework, you don't know which way to go. And so you do nothing. You're paralysed by fear. And being paralysed by fear doesn't help anyone. It's certainly not going to help you or the people you're trying to help.
Yeah.
That was beautifully put because I can relate to part of that.
Yeah.
So, okay, we talk about the 3-bucket strategy. What exactly is that?
Okay, this is a method for accumulating wealth and preserving wealth. So building your wealth, but also maintaining what you've got. There's an element of the 3-bucket strategy that applies to people of any age who are trying to accumulate wealth, who are trying to, we talked about the wealthing account in the past. So one bucket is a wealthing account, if you like. But the other two buckets, they're for a sort of a pre and post-retirement strategy. That's what this is for. So what we will do is we'll have another podcast down the track where we talk about all the different wealth accumulation strategies.
I'd love to know that.
If you're in your 20s and 30s and whatever, and what you can do to build wealth. So we'll do that. We'll have a dedicated potty for that.
That's fantastic.
But this is a particular strategy for people who find themselves a little bit lost about what to do in retirement to fund their, arguably what could be the most fun years of your life.
Totally.
Right? And so essentially what we've got is a simple way for people who don't have a lot of investment experience to construct a portfolio, have a strategy for managing that portfolio, and rebalance that portfolio. And as I hear myself say that, I'm already nodding off, which is why we call it the 3-bucket strategy, because it's so much easier to remember.
It is.
And it's more digestible than thinking about asset allocation and rebalancing portfolios and all that.
That's where you lose so many people with
Exactly.
that. Whereas bucket 1 is what, cash? Is that how does it go?
So bucket 1 is the bucket you fill with money that is going to meet your imminent spending and lifestyle needs.
Right, paying for your petrol and getting your
all
coffee
of
and
that
all
stuff.
that stuff.
So what you do with bucket 1 is you start by saying, okay, what income do I have? Have I got some income? So it might be that you're getting a pension. It might be that you've got income because somebody's sending it to you, whatever it is. And then you subtract from that or if you like, you look at that amount and then you say, well, how much more do I need for the next 2, 3, 4 years? How much cash am I going to need? And that amount of money is what you put in bucket 1. Now, you can split bucket 1 into cash, immediate cash, that's sort of transaction accounts that pay, actually it's really interesting. I got an invitation from the National Australia Bank the other day. They haven't followed through, and I've got to get onto them about this. But they said, oh, by the way, Roger, you've got all this money over here in this account, but we also notice that you've got a NAB trade account, which is where I invest in shares in this NAB trade account. If you transfer your money over to your NAB trade account, we'll give you 4.75%, I think it was, or 4.25%. 4.25%. So I said, yes, please do that for me. Of course, they've never got back to me, and it's been about 2 months. So I've missed out on interest there. So if they're listening, they better give me a call.
Yes, well, there you go.
And everyone else has been invited,
with what you say, don't you?
Anyway, so the point is bucket 1 is immediate cash needs. And the reason I said 2, 3 or 4 years is the purpose of bucket 1 is so that you don't dip into your investments to meet your spending needs if the market was down.
Right. Oh, okay, got it.
Right. So think about this for a minute. Let's say that you've got a certain amount of money. Let's say it's $1 million. It might not be. It might be a lot less than that. Doesn't matter what it is. But it's in the share market. It's all in stocks. And every year you're pulling money out. Let's say you're pulling a fixed amount out every year, $20,000 or $30,000, whatever it is. You're pulling that money out every year. If the stock market goes down 30, 40, 50%, and you're pulling out $30,000 or $40,000 every year, you're forced to sell more units at the low price. So to get that $30,000 or $40,000, you've got to sell a lot more shares to get the money because the share price has gone down. And that means you've got a lot less shares left for when the market recovers to make that money back.
So we don't have shares in bucket 1 then?
Shares aren't in bucket 1. Okay, shares are in bucket 3.
Okay.
We're going to come to that in a moment.
So bucket 1 sounds like peace of mind to me.
It's about, so you don't have to dip into your other assets for your immediate needs.
So
that's why
you
you're
sort of got that covered
out.
a bit. If you're sort of like financially sort of set there, you've got enough there to keep that covered for the next few years. You don't have to worry, and I guess you don't look at having high interest or something on that because I'm guessing if it's going to be more...
Well, that's why I was saying you might split that. So you might have some term deposits there because remember, the money that's in there is for 2, 3 or 4 years. Now, you only really need the first years in cash.
Yes.
The years 2, 3 and 4, they could be in a term deposit, for example, with a bank earning a better interest rate. for example. And we talk about, in my industry, we talk about cascading term deposits. So what that means is that you might have a 3-month term deposit, a 6-month term deposit, and a 12-month term deposit. And when the 3-month finishes, that goes into the 12-month. And now the old 6-month is now a 3-month. And the 12 months still has 9 months to go because 3 months have passed. They're cascading. And you end up with a yield, you end up with a return that's the average, if you like, of all three.
Gotcha. Right. Yeah.
So
wow.
that's
okay.
So bucket 1 is immediate cash needs for the next, let's say, 4 years.
Right.
But you're splitting it. 1 year's cash, and the other 3 years, that's in maybe term deposits.
That makes sense like that. It does. It makes sense.
I think that the peace of mind to me is like, okay, I have an income coming in to support my lifestyle.
Yes.
Whatever that may be.
Yeah.
It's a relative.
Yeah.
So
and if people say, oh, well, I can't afford my lifestyle.
Yeah. Well,
Yes.
hello.
Change your lifestyle.
Yeah. And I think
I'm
that's
sorry, there's
I
no
feel like-
escaping
I
that.
think
You know
that's
what? I'm glad you've said that
Yeah.
because there's a lot of people live beyond their means, particularly a lot of kids today with credit cards, and I mean plural.
Yeah, and this is a
I'll
tip.
max that. I'll get another one.
and
This is
also-
a tip for people. Sorry,
Yes,
Nicola,
no,
this
I
is
was
a tip
gonna
for
say,
people
because
who
they
are
hit
really
the card.
young,
Yes.
who are starting out in their jobs. You know, I've said this before, and you asked me to explain it. Pay yourself first. What do I mean by that? Put the
We've
money.
learnt that.
So we talked about the wealthing account. We mentioned the wealthing account briefly. We'll come back to that in a second when we talk about bucket 3. But you want to put money into that's yours, that is going to go to advancing your wealth first. Pay yourself first. And then with what you've got left over, live on that.
Yeah.
Right?
It's a good reminder, I think, for everybody. And it's also, there's no shame in it. And also that like whether it's overspending or whatever, if you can't afford some things, that's okay. You know, like there you live, but you can always then, as you sort of say, hustle, get different jobs or whatever. But I think it just makes sense to live within your means. You know, otherwise
a
it's
guaranteed way to have a miserable life is to envy what other people have.
Yeah. See,
it's
right?
so true.
life,
And
it's very
wisdom there,
true.
Roger. It's
And if we keep
And with
looking
social
at
media, isn't it? Like
if we keep looking at what other people have
they've got this.
yeah, and then that makes you feel terrible about yourself. So
Yeah.
it's not good.
It's
so
a
don't-
beautiful way to finish on bucket 1.
It
Okay,
is.
oh,
Yeah.
thank you for the- I
yes.
got that.
Yeah.
Do you like that? I've been in media enough to know.
Roger.
Briefly, Roger.
Roger's like, Roger that.
Got that? Got
Okay,
that?
Roger.
Okay, yes.
Okay, bucket
Number 2.
Okay, now bucket 2.
Let me finish my intro.
Yes.
I'm joking. No,
Okay.
no,
So-
because to be honest with you, it holds investments that generate steady regular income.
Yes.
It could also include things like term deposits, bonds, infrastructure, real estate investment trusts. So
And private credit,
and private credit,
which
Okay.
I think is
You-
probably
I don't
a
even
really
really know too much about that, Roger.
It's
Yeah,
this
we'll talk
one
about
that
that in a
intrigues
sec.
me more than all of them actually. Bucket 2. So
Okay.
can you just
So bucket
elaborate on
2
that?
is bucket 2 is the medium term bucket. So it's going to be one of the. So when you get to the end of your 4th year,
Yeah.
right, you don't have any cash left in bucket 1. So you've got to top that up. Now you're not topping it up at the end of 4 years. You're topping it up every year from bucket 2 or bucket 3, depending on their performance, right? Bucket 2 is the medium term bucket, not the long term bucket. That's bucket 3. And this is giving you stability, and this is supposed to give you security and confidence that bucket 1 will always have enough in it.
Okay, got it.
Okay.
It's
Right.
going for a higher return. So you talked about real estate investment trusts, infrastructure funds, those sorts of things that aim for a higher yield. But the asset class that I really, really am passionate about at the moment is private credit funds. So private credit funds, and just like stocks in the stock market, there's riskier ones and there's less riskier ones. So you want to go for the less riskier private credit funds. And people often just dismiss them out of hand. They just say, "Oh, private credit,
Can
that's
you
got to be
explain
risky."
it really what
Yeah,
it
a lot
is?
of people have
Okay.
no idea
You know,
what that is.
All right, well, let's go
Yes.
back to
Yeah.
first
Yeah.
principles.
Yes.
So when you buy shares on the stock market, you are buying into the equity of a business. What is the equity of a business? Well, if the business has some assets and then it has some liabilities. So let's say it has some property, it has a warehouse, it has some inventory, it's got some really nice clothing, and it's got all of that in the warehouse. They're the assets. Then you've got some liabilities. How did you fund those assets? Well, you borrowed long-term for the warehouse and you borrowed short-term for the inventory. They're your liabilities. If you take the liabilities away from the assets, what you have left over is your equity in the business. It's what you own. Another way of thinking of equity is what you've put into the business when you kicked it off, and what each year you leave in the business after you take some dividends out. What's left over in the business is your equity. Now, when you buy shares on the stock market, you're buying a share of the equity in a company.
That's so interesting hearing it that way. It's a great breakdown. It's really good hearing it like that.
Here's another interesting thing.
I love that.
There's a legal framework that sits around the order of who gets paid if a business fails.
Right.
And the equity owner, the owner of the business, gets paid last. You're the last one to be paid. The employees are paid. The creditors who gave you the stock, for example, they've got to be paid, or they come and take their stock back. If there's a bank loan, they've got security maybe over your house. They get paid first.
Yeah.
Everyone gets paid first, but everyone gets paid before you as the owner of a business. So when you're buying shares, you're buying equity and you're the last one to be paid.
Interesting.
After
Such
everything
a
else
great
is
way.
paid.
I never really think of it buying shares. You're actually buying into a business,
Yeah,
really.
it's a
Well, that's
great way of looking
where
at
it's
it.
kind of good because then you're kind of, a business owner.
We should talk about that in the next
It really
potty
is
because
great.
I'd love to break that down.
Yes.
well, most people buy shares because they think, or they go up and down on the market.
Yes.
Well, but that's betting. That's gambling. If you think about shares as a piece of a business, you'll think very differently.
Absolutely.
About how
I've
to
never
invest.
really thought of it
Now,
like
So
that.
coming back to private credit.
Yes.
Yeah.
So private credit doesn't own shares in a business.
No.
It's one of the lenders.
Okay, so it lends.
So where do
It's
they get paid
lending.
if things go
Well,
belly up?
well, that depends on whether the loans are secured or unsecured.
Okay.
Now, in the funds that I like, the private credit funds that I like, and the ones that I talk about on our blog and so on, they are secured loans. They're all secured loans. The other thing is that there are private credit funds that lend to property developers. I personally don't. I think that's quite risky. Now, other people say, no, we've got years and years of experience lending to property developers. But if you Google private credit property developer right now, all you're going to get is 20 headlines of property developers that have gone bust.
Of course.
Just in the last 6 months.
Yes.
You know,
Coming back
and
to secured loans.
So these are these are loans.
How are you
the ones that I
protected?
like are private credit funds that lend to small and medium-sized companies or corporates. They're lending secured. So they're taking a director's guarantee, or they're taking a lien over the general assets of the business, or they're taking security over the farm, or they're taking security over the livestock, or it might be a blueberry farmer, for example, who's just sold all their blueberries to Coles, but Coles isn't going to pay them for 3 months or maybe even longer, but they want the money now, and so there's an invoice financing company that says, yes, we'll give you the money, but we'll collect from Coles and Woolies because they owe you.
Okay.
We'll give you less than what Coles and Woolies owe you, and we'll keep the difference as our fee for giving you the money today. So, that sort of lending, that provision of credit is secured in that instance against the IOU from Coles and Woolworths. Right?
So the pecking order of where you'll be paid if things go wrong with this particular business, where is the pecking order of someone like, for example, myself? If I've invested, where am I secure with private
if you're
credit?
invested in a
if
fund,
it's a secured one.
if you're invested in a fund that provides loans to businesses that are all secured,
Yes.
well, if something goes bad,
Yes.
there'll be a process for collecting that security, and then you'll get paid. The loan will be paid back with penalty interest often.
Yes.
Right. So it's really important to understand there's a legal process that is reminding you as a lender, particularly if it's a secured loan, that you're paid before the equity holders in the business.
Got it. Okay. That's great.
So private credit it's doing, and let me say something else about private credit. If you'd told me, I don't know, 15 years ago that you were going to lend to businesses in Australia, I would have said, Nicola, don't do it. It's really risky. You're only going to be given the opportunity to lend to businesses who can't get a loan from a bank.
Yes.
Now, people might be saying right now, well, isn't that true today, Roger, as well? Well, what's happened is since the global financial crisis, regulation has been piled on the banks about how much capital they need to back certain types of loans. And that means they've pulled away from lending to small and medium-sized corporates in Australia. They're not interested. They're interested in the bigger loans with bigger companies. They're not that interested. And so what's happened is there's a gap now in Australia. There's about a $400 billion gap between what business in Australia would like to borrow for growth. We're not talking about distressed businesses who are trying to get out of trouble.
No.
These are businesses that just need money to grow. There's a $400 billion gap between what they want and what banks are willing to give.
That's so interesting.
That gap has been filled by private credit funds.
Well, yeah.
Yeah, or is being filled. It's still only new in Australia. You know, it's only 9% of lending in Australia is through private credit, whereas in Europe and the United States, it's mostly private credit.
How does that compare to banks? Or how many?
Well, banks are the banks are the rest, basically, in Australia.
Wow, that's amazing. So it's only 9%.
It's only
But
it's growing.
It must be growing now.
It is growing.
I think it's brilliant. Honestly,
It just
I've never
seems
heard of it before.
such a good way.
I've been reading up on it.
But it makes sense now why it's actually happened as well too.
And look,
the last 15 years.
Yeah.
I'm not going to sell anything today. You know, that's not. This is all about education. But there are funds out there. There are funds out there that have been running for 8 years or almost 8 years that have generated circa 9.5% returns, and they've never had a negative month. So they've done as good as the stock market over 8 years, but where the stock market's swung up and down,
it's not volatile.
and
it's safe.
they've produced monthly income. So it's perfect for bucket 2. You know, that's
I
that's
was
the
going to
kind
actually
of thing-
ask that too. How do you get your money out of private credit?
Well, you have to
like
Are
these
you
are
stuck
funds.
for years?
No, these are funds usually with 30 days
30
notice.
days, so you can get access to
So
it every 30 days.
it's called monthly liquidity. But
So
that's
it's
another feature.
user-friendly.
Yes,
But that's another
Love
feature you have
that.
to look at before diving in. And you should get some advice that's specific to your needs and circumstances before you go and buy anything.
Well, I hope people are learning something new like that. We certainly are, aren't we?
But for bucket
this is,
2, it's an ideal thing to consider really carefully, because what it's doing is it's producing hopefully a reliable return. Of course, the past is not a guarantee for future returns. It's not and in fact, ASIC says that financial advisors like us, we have to say history is not a reliable guide to future returns. And so it's really important to understand that. But for the purposes of bucket 2, it's something that you should seriously consider, as well as...
And you don't put all your eggs in the one basket either,
well,
which is a good way of
that's why
doing
infrastructure funds could be of interest. You know, you could look at fixed interest or bonds and those sorts of things. But really, I think private credit fits bucket 2 really quite
I've
nicely.
been reading up on private credit. I've never heard of it before.
great.
I met you, Roger,
Right.
and I never heard the term.
Yes.
And I find it, for me, because the share market frightens me, to be honest, because I have quite a few shares, and I go, oh no, they've gone down today, and then next week I go, oh, they're back up. I'm so over it, like the dipsy-dervy going on in my brain around it.
Well, we've found...
Whereas something that's solid, like, and I call it solid.
There are risks.
I could be wrong,
You're not allowed to say it's solid.
No,
but
that's me, okay? Because I'm not a financial advisor.
Sure.
I look at it in comparison to the way I look at the share market, which is volatile.
Yeah.
And did you say women are quite adverse to investing in things that are volatile? Isn't that weird?
Well, I think whatever
Well,
you invest
as a
in...
generalisation, I guess, that we are.
I think it's really important whatever you invest in, whether it's the stock market or private credit or whatever it is, it's important to understand the risks. And so we are going out of our way to explain those risks to people, and I do that I'm doing it here with you. I do it on the blog, and we're always talking about the downsides, the worst case scenario.
Hey, look, you go to the doctor for a Panadol and they'll go, like that, you can have this, that. Everyone has to sort of say the downsides of things too. So you've got to seriously,
it's
you can't
true
be,
what you're saying.
you have to be
One of the-
real
At the end
until,
of the day,
isn't
you've got to
it?
sit back in yourself and
Yes.
go, which direction?
Exactly.
One of the big
Agree.
risks for
You
private
know.
credit
Yeah.
and any fund, even a stock market fund, is that if all the investors wanted to get their money out all at once, all at the same time.
Yeah, of course.
Trump does something crazy,
Yeah.
presses a big red button and, something nuts happens and everyone wants their money all at once.
Yeah.
Right.
If you're in a private credit fund
Yeah.
that has lent money for 2 and 3 years, well, what the manager would do is it's called gating the fund. They close the gate and they say, you can all get your money as the loans are repaid, which means it's going to be 2 or 3 years before you get the money back because the loans have to be repaid. All the money you've invested has been lent out.
Mm-hmm.
So that's what's really important, I think, to consider whether or not a fund that has shorter term loans, maybe 3 or 4 month or 5 month loans or 6 month loans, is that preferable? Because in that scenario, you are more likely to get a part of your money back in a shorter period of time. You're not waiting
Good
3 or 4
point,
years.
Roger, too. I think, especially with
I
Di, when
agree.
you're sort of saying it too, it's sort of a bit more, it was just sort of saying comforting and stress-free when you know then, if you're going to put it in, if you don't have to
There's
worry
risk in
at all
everything.
for years, you're not
Exactly.
really going to look at it.
And-
but if
and
you do
remember-
want access to it, you have to sort of
And
know which
remember,
one
we've
you're
got
going to put
3
it in.
buckets.
Yeah, okay, so what
Remember
about
that-
bucket number
okay,
3?
So let's summarise where we
Yes,
are.
okay,
We've got
one.
bucket 1, which
Yep.
is our imminent cash
Yep.
needs.
Yes.
Yep,
We've
one.
got bucket 2, which is trying to generate a stable-ish higher return.
Yes.
Okay, so we're looking for enhanced income. That's what we call it. So I hate using lingo, sorry. But enhanced income. We're trying to find things. And then we've got our third bucket.
Yeah.
What's
The
that?
third bucket is the growth bucket.
I love how you're not in trouble.
Yes.
You didn't do the intro. He went straight to it, and you
I know.
didn't interrupt him like the
No.
principal
I know, this
died.
one can be bossy. Depends
Okay.
what mood she's in.
No, it's like now.
So I just
the
need-
third bucket. I love it.
I just need to talk to Tash about whether we come back next time.
Oh, poor Roger.
So you go straight into
right.
bucket
So
3.
She's scary,
So
Di.
this is great. First, second, that's the third.
Yeah,
Okay.
so I came up with a different metaphor than buckets last time we spoke, and I think I talked about building a boat.
Yes.
Yeah,
Yeah,
you
you did.
I love that.
We had
know.
the hull of the boat.
You're a
Brilliant.
boaty chickie.
I
Yeah,
am.
we
I
had the
love
hull
it.
of the boat. That's
Resonated.
keeping us
Like
dry and
Tash.
safe and afloat.
Yeah.
And then we needed an engine to make sure we're always pointed into the waves so we
Yeah.
don't get overwhelmed.
Yes.
And then I also said, look, for a bit of razzmatazz, a little bit of excitement, you could have a turbo on your engine.
Yes, that's
Right, I
right.
remember
I know, I
and
love
they're
it.
in proportion, right?
Speaking our language.
The bulk of the money is
Truly.
in the hull. A little bit, you have less in the engine, and then you have a lot less in the turbo. They're proportional. So bucket 3 is the outboard engine, if you like, and the turbo combined.
Such a good way of
Right?
thinking
Love it.
about it.
That's what we're trying to do.
great.
So the returns in this bucket are going to vary a lot more than the other two.
Yeah.
Right? There's going to be virtually no variation in bucket 1. You might, depending on the types of assets you put in bucket 2 to go for income, there might be some variability there. And in bucket 3, there's lots of variability. The whole point of the first 2 buckets is if the stock market falls, because you've got some money in shares in bucket 3, if the stock market falls tomorrow, let's say it falls 50%,
Yeah.
it could take 2 or 3 or 4 years to recover. And so you don't want to dip into that. You want to allow it to recover. So you're putting money into this bucket that is for your long-term needs. So if you like, think about it's not for this purpose, but if bucket 1 runs out, when bucket 1 runs out and bucket 2 runs out, you're now dipping into this bucket. But we haven't talked about how we
how we sort of manage them
rebalance
all
the
up.
buckets yet.
But such a great way of going to
in terms of principles, this is the long-term bucket. This is where you're going to be able to afford that really nice bottle of wine in 10 years' time, because you've been able to afford it today, but you want your wealth to go up because the price of that wine's going to rise.
Yeah.
I think I talked in the past about
did about the
Sonnery.
bottle of
did.
the bottle of
Sonnery.
red.
So we
Shoot
can
back into
finally
our
drink
other
it,
ones.
Can we? In bucket
Yes,
3.
yes, yeah.
I'll fill the bucket full of the Sonnery. I'll
Used
have
to
a
be-
bucket of it.
When I used to
I'm
buy it, it was
loving
it.
$14 a bottle.
You're
Yes,
kidding
wow.
me.
$14 from that
Well,
little...
We drink the Lisa McGuigan
From the
wines
little-
now.
Yes.
So yeah.
That's Incredible.
$14 at a little bottle shop at the back of the Orpheum. At the back of the Orpheum in Cremorne.
That is so funny.
Yeah.
Oh, wow.
How long ago was that?
That was in the early 90s.
Wow.
It's not that old, Dottie.
No, that's actually incredible. $14.
And now it's 10 times that.
But do you know what, Roger? This is really good what you've said.
I've still got some of those first bottles.
Well, I'm coming to your place for dinner.
Still says
Cheers to
Claret
that
on
one.
it.
With my bucket.
Cheers
I
with
don't
a
think they're
glass
good
of
drinking
wine.
now, by the way. They've gone too far.
Let's rehash on bucket three.
Let's go back.
Right.
So with bucket 3 is like growth, and that's for later. Think superannuation shares, property or managed funds that grow over time. So going over, like you've got bucket 1 gives you peace of mind.
Yes.
Which is good. Bucket 2 will give you an income. And bucket 3 gives you that long-term financial freedom.
Yeah. And bucket 3, because it tends to be variable,
Yeah.
you don't want to be dipping into that next year and the year after.
Absolutely.
You want to set that and not worry about it. There will be strategies about managing that, and that's where your advisor might help, or we'll talk about that in the next potty, because we're going to talk about the growth stuff.
Yeah.
Okay, so now we've got our 3 buckets.
Yeah.
What we need to do now is think about funding bucket 1. The whole strategy is about there's all those financial terms, rebalancing and asset allocation and tactical asset allocation, strategic. Don't worry about that for now.
Yep.
What we're trying to do is rebalance the buckets so that at the start of every year, we have that 2, 3 or 4 years of cash in bucket 1. Right? So a year's passed. We've spent year 1's cash from bucket 1. Now what we have to do is top up bucket 1 again so that it's still got the 4 years in it. Now, you can do that a couple of ways. More than likely, if you're in, for example, private credit and it's been a stable year, or you've been in retail investment trusts or infrastructure funds, then bucket 2 will have gone up, and you'll be able to and bucket 3 will have gone up, and you'll be able to take some money from each to put into
Like
bucket 1
dividends
for another
and-
year. Dividends,
Yes.
for example, or you might realise some capital gains if you wanted to. Depends on what you've got, what's happened. It could be you've had a cracker of a year in bucket 3, and you just take a little bit of money out of bucket 3, and that's enough for bucket 1.
Right.
It could be that bucket 2's gone up, bucket 3's gone down, right?
Yeah.
And if bucket 2's gone up and bucket 3's gone down, well, you draw it from bucket 2
Absolutely.
to fund bucket 1. The third scenario is that both bucket 2 and bucket 3 have gone down. Now, if you've got a fair bit in private credit and in other high-yielding income, then it's less likely that bucket 2's gone down. But let's just say that they've both gone down because it's not...
Just a quick, can I just interject, just someone listening to, just a quick question on this when they're in hearing it saving with private credit. How much do you need to even put into private credit?
You can do it with as little as $10,000.
Oh, okay.
Yeah,
That's interesting.
it
Just so
depends.
someone might be listening going, I mightn't have that, to put in. So I
and
just
there are
want to...
private credit funds that are listed on the stock market as well. But the risk with those guys, I mean, most of the time they'll behave like an unlisted private credit fund.
Right.
But if there's a big crash in the stock market, people go to the stock market to get their money out.
Of course they do.
They'll sell everything.
Yes,
and
they
so
will. Yeah.
and so
it defeats the purpose.
the units or the shares of
Right.
a listed private credit fund will behave like lots of other shares in that sort of scenario.
Yeah.
So you just got to be mindful of that. Anyway, so there's 3 scenarios. Both buckets produce a positive return.
Yep.
Second scenario, one's positive, one's negative. Third scenario, both negative. Now, if they're both negative, we've talked about the other 2 scenarios already.
Yeah.
If they're both negative, then you don't touch them, right? Because you've still got another 3 years left.
And that
in your
keeps the
bucket.
stress,
See,
and that's that makes the stress from you, isn't it?
Lies the structure
Yes.
that you're yearning for.
Yes.
I love this.
Yeah,
Yeah.
and so now...
So it's a fallback. I love
the whole
it.
point...
That's a
It's
good way of saying
well,
it,
it's
Di. A
reassuring
fallback is a
too.
really good
Yeah.
way of saying it,
Well,
a really
it's
simple
important.
term. And
It's
'cause
essential.
When we're sort of saying we do want it to kind of stress-free, and this is
Yeah.
more of a simple way that we can kind of understand that way, and it's like nearly someone's got your back
I
a
mean,
bit.
I'm sure there's people going, oh, bucket 1, bucket 2. But honestly, guys, at the end of the day, if you probably re-listen to it
Yes,
also.
yeah. And
because Nick and I have
yes.
read up on this, so we've got a better understanding. But it's very, very logical.
Yes.
And
We've
for
got
my
a-
Capricorn brain,
Yeah.
honestly, it's it works. It works.
It does.
It's
and
magic.
I think it's good too because you can get paid monthly despite what's going on in the world there. And it can also kind of, as you're saying, calm the farm of things too.
And I love the fact that if 2 and 3 fail, you have budgeted if you want with the I can't think of a better word than budgeting.
Yeah.
But you've budgeted for those 3 years.
Yes.
So you're safe is, I guess, a good word too.
Yeah.
You know, you put faith in what your buckets.
Correct.
Okay, that's fine. The share market will go up. Things will change. So you're still living. You're still going on holiday. You're still feeding yourself. You're still paying your rent. Whatever.
And if you're lucky,
it's reassuring.
If the market does have a big sell-off, we know that the best time, and we'll talk more about this in the next podcast, but we know that the best time to buy shares is when everyone else is selling them.
Yes. I think
Warren Buffett said, Warren Buffett said,
Warren.
He said, you want to be greedy when others are fearful and fearful when others are gready. And so if the stock
Another
market...
famous...
Isn't it? I love I love that with the Warren Buffett quote.
So if the stock market does have a big conniption, then what you might do is you might say, you know what, now could be a really, really good time to actually take some money out of bucket 2 and put it into bucket 3.
Oh, wow. Okay.
Right? So now look at this. I can see the wheels turning.
You can.
You're starting to think tactically. You're starting to think like a professional investor.
Oh, I like that.
I just got goosebumps for
We've
that.
done it with 3 buckets.
And when you were saying about giving you confidence, it's just sort of by starting and doing something really simple, and even with your finances there, even getting it and sort of even writing it down in like the 3 different areas if you can. And, it just, I think by doing it in the now is giving you that sort of confidence.
So just reiterating.
So let's go. So
there's one more step. So there's one more.
Yeah.
Tell us.
If you get to only 2 years left in your bucket, in your first bucket,
right.
Let's say, or you get down.
Yeah, that was in the back of my mind. Yeah.
Let's say you start to get down to the point where you're going, I've only got 2 years there.
Budget for
Well,
X amount.
what you do then is you go in equally. You take half from bucket 2 and half from bucket 3 and top up bucket 1
kick
again.
that bucket over.
Just in reiterating.
Don't kick the bucket.
I love that. As long as it hasn't got my wine in
Someone
it.
always says it.
I know.
Someone always
This
says it.
one's
I'm just reiterating bucket 3. It can
so-
be superannuation. It can be Australian or global shares, managed funds.
Well, the whole thing, superannuation is a structure where all of your investments are.
Yes, okay.
So all 3, if you're in, let's say you've retired and you're in what's called pension phase where you're now drawing on your investments, all 3 buckets
Absolutely.
are in your super
I'm glad you
fund.
identified that.
Yeah, all 3
but if
buckets
you're
are
not
inside
retired,
super. If you're not retired, well, you're probably still accumulating.
Yes.
So it's mostly bucket 3.
It is.
You know, and bucket 2 and bucket 3. And what I've found is,
look at us.
I know we're going. I know there's so many things. I know we're so
I love this about
as people,
blows my mind.
It's our favourite subject.
what we found is, we started our business in 2010, and or this Montgomery Investment Management, and we've got clients who've been with us from the very first day, and those clients are now substantially older, 15 years older than they were when we started. Their appetite for volatility in the stock market is diminishing. And so they're thinking, well, where else could I invest that gives me a decent return, but I don't have to stomach all the highs and lows and I don't have to worry about that anymore. And this is happening globally, which is why private credit is growing so much.
That's interesting.
It's because people are saying, you know what, I'm satisfied with 7.5% or 8.5% or whatever the return is. That long term is what the stock market's given me, but it's given me heartache as well.
Thank you. I was about to
and
say
lots of
that.
stress.
Every
Exactly.
week.
I
I'm
know.
like, oh my
You know,
God.
but the reality is that the stock market can deliver those 30%
it
years,
can.
those 20 and 30% years.
But as you get older, you want to be something a little bit more solid.
Which is
I
again
get
why
that.
why
I'm not old yet,
No.
but I get
and what
it.
the buckets
Yeah.
do is they
It's just
force you to
going out.
diversify. the buckets are
chicken.
forcing you to be diversified across asset classes.
Sorry, what was that?
The buckets, the 3 bucket
Yes.
strategy,
Yeah.
it's forcing you to think about diversification, which is a good thing. It's forcing you to think about asset allocation, and it's forcing you to think about rebalancing and strategy, which which is
I think like
you
anything
guys
in
get
life
it now.
too.
You've got it, and we just did it with 3 buckets.
It's having
and by the way,
a
I
basic
didn't
plan.
I didn't
isn't
invent
it?
the 3 bucket strategy. It was invented decades ago by an American financial planner, and I think it's a really, really robust way for people who aren't professional investors
It's a
to think
great,
about all the
simple
important
way.
things about managing money.
Yeah, and how often should you be checking it too? You know, like going through, with your buckets and what's in one and what's in the other and stuff too.
Well, every year, at the start of every year, you want to make sure you've got, 2, 3, 4, some even say 5 years in bucket 1.
Yes.
Right? So every year you're going through that process in a very disciplined way and looking at which buckets you're going to take the money from. But within bucket 3, it's not going to all be in one company's shares. You're going to have, you might have global shares, you might have domestic shares, you might have small companies and large companies. You might even have an arbitrage fund on these. These are all called alternatives. So you might have a long short fund, and everyone's just rolling their eyes listening to this. But my job here on the potty is to explain this stuff to people.
I know,
so
and it's really good to hear
we
those
will.
things. And also you're learning different things every time, every episode. We didn't even know about wealthing accounts before, and private credit and strategies.
So bucket 3 is where you think about rebalancing, and you might balance quarterly, that bucket 3, or you might rebalance every 6 months, just to make sure that, hey, these shares have done really well. I'm going to trim those.
Yes,
These shares have done poorly, but I know they're still really good quality, so I might take some money out of the ones that have performed well and put them in the ones that haven't performed as well, or whatever. Again, this is where if you've got a decent amount of money to manage, this is where speaking to an advisor is going to help. But at least now you're armed with some really good information, and it's going to empower you to ask the right questions.
In summing up, I love you just to very briefly go bucket 1, bucket 2, bucket 3. Starting with, for example, bucket 1. You mentioned something like, what do I need now is bucket 1.
Bucket 1 is your imminent cash needs. So for the next few years.
Bucket 2.
Bucket 2 is cash-like, but with an enhanced return, and that's going to help fund bucket 1 as the years go on. And then bucket 3 is your long-term growth bucket.
Or the future.
That's for the future. And that's where, if there's a really, really good year, you take, because it's rare to get, we're in the 3rd consecutive double-digit year in the stock market at the moment in the United States, which is quite rare. It's rare. But when you get those, you say, thank you very much, because I'm going to take some money out of that now, and I'm going to take some profits out of that, and I'm going to put it back into bucket 1.
Like, wow.
Okay, so bucket 1 now.
Yes.
Bucket 2 soon.
Soon.
Yep.
Bucket 3 future.
Later.
Future.
Do you want to be because just for some of the listeners, including Nicola and I, to get a handle on the 3 buckets, because it's so logical. And I can't stop coming back to the word structure, because I was all over the shop.
Yeah, and there are people
flicking flames.
There are people in my industry who'll say, "Oh, Roger, that's way too simple." But what those people don't appreciate is
it's
that
so not.
If you're not an investor, then you need as I said right at the start, you need a framework to help you start thinking about those important things. Yeah. So if I was speaking to other people in my industry, we'd be talking about strategic and tactical asset allocation, portfolio rebalancing, all this stuff.
Yes, yeah.
It's just to make everyone go, what on earth is he talking about?
We have the red wine out then, don't we?
You were so funny to kick the bucket. I love
kick
that.
the bucket.
And so the purpose of explaining it with 3 buckets is to make it approachable for everyone.
And you know what, when you're saying for everybody, because, it's great because we do have people of all ages listening to the podcast as well too. So you've got people in your 30s here. So starting, they can, I guess, put in more for number 3 because they've got longer. Would that be right?
They've got it. Then, think of the snowball.
Yes,
at the top of the hill.
Yes,
right?
I love this one.
People in their 20s and 30s, they've got a really long ski run. So, they can the sooner they get started, the bigger that snowball's going to be at the bottom of the run.
So it's great for anyone listening as well, to younger listeners as well, going, it's so good because you've actually got more time to keep on just putting that in.
Can I butt in and ask
Yes,
a younger
please.
person question?
I'd love that, please.
And I don't want to throw a spanner in the works.
Are you on?
Go on.
Are you
This
on a
is Sam.
snowball,
We might have
Sam?
discussed it, and I don't know what your opinion on this is, but I feel like any
Yes.
younger person listening is going, where does crypto fit into this?
Oh my goodness! I think that's another
Crypto's a
podcast.
great
But I
one.
was thinking that
Is
too the
it
other
in any
day.
of the buckets? Is it too hot?
Good question.
Where does it fit in?
It's on every ad on the radio at the moment.
All
too.
right, so
Yeah.
I've written a lot about cryptocurrencies, and I'm not going to be one of those people who dismisses it out of hand, because I firmly believe that the legislation is moving. And if you look at what PayPal, Visa, MasterCard, and Stripe have done, they're accepting stable coins. We need a whole nother potty to talk about with
Yeah.
cryptocurrency
We do actually,
world.
but it's a
But-
good
But it's a great
question,
question,
Sam.
which-
They're not
It's
going
funny. It's been
anywhere.
on the tip
Yeah.
of my tongue
I do
too.
think so.
They're not a flash in the pan. The cryptocurrency is going to be around. It's going to be around in 10 years'
So
time.
let's not dismiss it then. Is
So
that
we're
what
not
you're
going to
saying?
dismiss it.
Okay.
But where it sits,
Yeah.
probably bucket 3.
I was going to say bucket
Yeah,
3.
probably
Yeah.
bucket 3.
Yeah.
So, and at the moment, what I'm nervous about is that there could be a little bit more left in Bitcoin's price. But Bitcoin's price is fueled by central bank liquidity. Now, I know I'm getting very technical. Central banks are like the Reserve Bank of Australia, the US Federal Reserve, and so on. And they are, central banks around the world, on an aggregate basis, have been pumping liquidity into financial markets over the last few years. In fact, they've been doing it since the global financial crisis. And that supports buying of cryptocurrencies. If that liquidity starts to diminish or deteriorate, then you could see cryptocurrencies start to come down. Now, some experts who follow global liquidity are suggesting that at some point next year in 2026, liquidity is going to peak. And that means that
Isn't it interesting?
Bitcoin might stop going up. And so, yeah, I've owned some Bitcoin, but I've been selling Bitcoin recently. That could be wrong and it could go up a bit more. That's okay, because I think in the next 12 months or so, there could be another correction. But again, that's a
And Sam, it was a
crystal
really
ball
good question
gazing.
just
I don't
to
know.
throw
It
out
is.
there too, because it's also
Bucket
it
three
But it's a
seems
small,
to be
and a small part of bucket 3.
It's
Yeah.
an
Sam.
honorary.
Yes,
It's not all of your
exactly.
bucket, unless you're a crypto bro.
Yeah.
You know.
Yeah.
Well, we want to
No.
get
No.
now. So I think they were sort of getting it
It's
too,
certainly
like.
topical.
And so in your
Sure.
60s and 70s, focus more on bucket 1, bucket 2, because, before you do kick the bucket,
Yeah, exactly.
how much time have you got left?
Kicking the bucket.
But
I'm
we
feeling
kind
it,
of
she's
get that,
kicking it.
But we also want to now know, this has just been so good, just some of your final tips for our listeners here of, so like what's one thing a listener in their 30s, 50s or 70s, we span it all here, can do this week to feel more confident in control of their money?
Turn the stock market and all those news reports off.
Oh,
Turn it
go.
off because they're distracting. They're not particularly informative. Knowing that gold went up or down, or oil went up or down, or the Aussie dollar went up or down, or the stock market went up, who cares?
Yeah.
Because all of those assets sit in the third bucket. They're long term. It doesn't matter what happened today. Where you really want to take notice is when the commercial radio stations lead their news break with the stock market crashing. Because by the time they do that, it's about finished crashing.
Right.
Okay,
So-
there's a tip.
Well, it's
That's
overnight.
a Roger tip. That's a
Yep,
great
so there you
one
go.
too.
Yeah, no, that's great.
Well,
Because
honestly,
it's overnight, isn't
how
it?
do you
Like
feel?
we said.
I tell you, I feel really.
You know how I feel?
Yeah, too.
And I've talked to you about this
yes,
a lot
yeah.
driving in, how I feel more confident, I feel more relaxed. I still get a bit stressy,
Sure.
but I used to be in the stratosphere with my stress.
Yeah.
So
Yeah,
fearful,
yeah.
so it clouded my
Yeah, you
judgment.
were very
it clouded
stressed.
my process around organisation and structure.
Well,
right
I think
now I've lost a lot of that fear and anxiety.
Yeah.
So the structure's landing.
So
with
we
me,
hope this can
actually
help everyone
landing.
listening too.
So I
that-
feel,
That's great.
I actually feel emotional, and I cannot believe
oh,
I'm even saying
yay!
that. Like,
Don't
good.
turn for tears.
I was saying
'Cause you
to
realise
Roger,
that
my
you're
accountant
you're
is really
empowered.
proud of
Di.
me. He just went, how come you asking this question? You're so different. And I went, because I'm calmer about it around it
Yeah.
all.
Yeah,
So,
that's
and you
beautiful.
know what it is? It's called education. I
we're,
listen.
we're fearful
I
of
didn't
what
close
we
off.
don't know.
Yeah.
And if you start
That's a
to
good
learn about
point,
something,
isn't it?
any remaining anxiety has nothing. It's not the same anxiety as before. It's now that you realise, wow, there's a lot to learn. That's all it is.
Yeah. And
all you're
learning
realising
can
is,
be
hey,
fun
I'd like to know
too.
more.
Well, I turned the volume up.
Yeah.
That's what I did.
Yeah.
Right? And I'm happy to do that. So thanks, Roger.
Yeah, so
Oh,
thank
guys,
you,
I'm so-
Roger, and thank you. And to many of our,
no worries.
and you know what, Di, you're
And
not
ever
alone. Many of our listeners are saying they're saying, had their head in the sand for so long, or just didn't know what to do.
I do live at the beach.
So. Yeah, that's right.
Still getting the granules out of
in
my
the
ears.
surf there, but so look, if this episode's helped you feel more confident, certainly made us feel more confident too. Please share it with a friend or a loved one, sort of someone there, because these are
'cause you can help
conversations
them.
now that we all should be having. It was we were saying before, it's no longer taboo. It's sort of
No,
like it's
thank
very
God.
in. Listen to also the podcast with Roger earlier, which are just fantastic as well.
Thank
you. We are on YouTube as well, so we want people to come and watch us.
I am going to ask a final question. If
Okay,
I may.
you can.
Are we in
You
trouble?
can-
So we're always
yes,
going over
yeah.
time. There was a question I want to put to Roger. Someone was actually talking to me about this week because for some reason I talk about finance. I can't believe it. If you're listening to this potty in 6 months' time or 6 years down the track, can you help us with 3 questions you can ask to get a feel for the market right now? In other words, it's up,
that's a
it's
good-
down, it's round and round. But I've just listened to Roger on over the back fence, over the money fence, and I'm okay. Yeah, but it's 6 years on. What are the questions or something I could be asking?
Gosh, if somebody
It's out
finds
there.
this in 6 years'
They
time,
will be. They will be.
They
They'll
are
be watching you. They'll be
dedicated.
watching.
They are very
I just
dedicated. So
want a
congratulations to
timeless-
you.
A timeless question is what I'm asking.
So if
Is
it's
that possible?
2031 and you're listening to this right now, here's what you can do. And by the way, pat yourself on the back because you found this.
Yeah. Yay.
There's 3 things. There's 3 things that markets need to go up. Number 1, they need liquidity rising. So central banks are putting money into the market. So Google that. In 2031,
Central
people might not be
banks,
Googling.
which you mentioned
Yeah,
They might
that's
be doing
true.
something
That's
else.
true. We're
Yeah,
living
it'll be AI. Yeah,
How
correct.
crazy
Exactly.
is that?
Yeah.
I talk
So,
to it.
Yeah.
so are central banks putting liquidity into the market? If liquidity is going up, that's a good thing. Number 2, do we have positive economic growth? It can be anemic, but as long as global growth is positive, that's also good for markets. And number 3, and arguably one of the more important ones, do we have accelerating inflation or decelerating inflation, which is called deflation, because you want deflation. You want the inflation rate today to be lower than it was last year and the year before and the year before that. And if you have those 3 things in 2031, then the market's probably going to have a good year.
Wow.
Very
That's actually incredible.
Yeah.
I'm actually going to type that up and put it, on my my wall.
So
in
she
front of
does.
my
She's got her
computer.
things
Nicola
there. I love
comes
it.
and goes,
Di's
"What's up
cute.
there
She's the
now?"
old-fashioned. She gets the.
Thank you
and
for
types
that
it all up.
because I think that's very relative because podcasts last, well, I hope
That's when you
forever.
can tune in. You can listen to
Yeah.
these ones in
It's
years
very
down
relative.
the track.
Thank you.
Yeah, no problem.
Well, thank you
appreciate-
everyone for listening.
And if anyone
Yes.
missed what we were talking about with the 3-bucket strategy,
Yeah.
we've put it down on paper.
Yes.
And
Which
so
is
people
great.
can go to the
Simple to our
So
show
guys,
notes.
in
Go
other
to the
words,
show
it's a
notes. It'll be
synopsis
there.
of today is
Yes.
going to be in the show notes.
And the
So,
simplified
how
way
easy
as
is
well,
that?
a
Yeah,
very
thank you for that,
simplified way.
Roger.
Yeah. So thank
As
you,
usual.
everybody.
No
Thank
worries.
you.
Easy.
Yeah, and so you can tune in. We'll have you back on again next month as
look
well
forward
for
to
our
it.
Well,
favourite
I've been at
monthly segment.
Financial University lecture today, and I've loved every minute of it.
Oh,
Thanks,
it's been
Rog.
fantastic.
Take
Yeah,
care.
thanks, Roger.
You too.
Yeah, ciao, ciao.
Bye.
Thanks for listening.
We don't ask Roger the questions, do we? Because
What's
it's the finance one. We don't say questions. Yeah, our signature questions.
No.